The first deadly sin of real estate investing is being so afraid of making a mistake that you don't do anything. This is sometimes called paralysis by analysis. And in some cases, it can last for years. I will willingly admit to you right now that I have made plenty of mistakes. Every successful real estate investor that you can think of has made mistakes too. It is highly recommended that you accept the fact that you will make mistakes. Once you accept the idea that you're going to make mistakes, it makes it a lot easier to focus on taking action. The second deadly sin of real estate investing is overpaying for properties. We have just come out of a market when buyers went completely crazy, overpaying for houses, waiving inspections, doing whatever it took to buy a house. And this is not just limited to buyers who had a ton of money because they sold their house on the West Coast. Every one of the big name iBuyers got caught up in the frenzy too, and they overpaid for houses. Zillow lost $500 million in a single quarter, and Open Door lost $1.4 billion in a year. Let's make this simple. When do you think you're going to encounter the highest risk of overpaying for property? When everybody else is actively trying to buy a property in that same area. Let's consider an example from the Austin Metro. There has been a lot of investor activity in the older neighborhoods just outside of downtown. There are several examples of this in East Austin. The investor buys an older home, tears it down, then builds a much bigger home on that large lot. Now, as more and more of this begins to happen, the value of the other homes in that neighborhood goes up, at least in the minds of the owners of those other older homes. But let me ask you this question. Who do you think got the most favorable terms if they bought in that area? That investor who bought a year ago when there were 20 other investors trying to buy the same property? Or the investor who bought before all that development began? Now, I know we can't go back in time, but this example does bring up two very important points. One, a real estate investor should always be thinking long-term, unless of course you're a flipper or a speculator and you're looking at what the value is going to be in 6 to 12 months. Now, the second important point is that every real estate investor should be thinking about where is that demand going to be in the future, not where is the demand right now. You know, I make these videos to provide information so that you can make better decisions if you're buying or selling real estate. But the only way I'll know if you like them or if you find them useful is if you leave a comment on the video, like the video, or subscribe to my channel. Also, if you think about buying real estate here in the Austin area, I would love to help you out. You can shoot me a text or an email or schedule a phone call on the YouTube channel page. But enough about that. Let's get back to the 7 deadly sins of real estate investing. The third deadly sin is focusing on low priority criteria. I've had real estate investors contact me about helping them find properties, and their highest priority is finding a house in an area with a low tax rate. Now, I get it. Property taxes in Texas can be a huge expense that could either make or break a real estate investing deal. Not to mention, if it's an investment property, you're not going to be able to homestead it and cap the yearly increase in property taxes. And your appraised value goes up 40%, your taxes could go up 40% as well. Just ask any investor who owned a house and got an appraisal in 2022. But here's the thing. If you make getting a low tax rate a high priority in your home search, you're going to eliminate options that might provide a better return on your investment. Most renters are going to be very concerned about the school district. If we acknowledge that most of the highly rated school districts are in the northern suburbs, Leander, Cedar Park, Round Rock, and all the rest, but the tax rate in all of those cities are in the 2.5% to 3% range. So if you're only going to consider properties with a low tax rate, you would eliminate all of the houses available in these northern suburbs, which means you could miss out on buying a rental house that's going to have a much higher demand and probably one where you're going to be able to charge a higher amount of rent. Now, the fourth deadly sin of real estate investing is failing to do your due diligence, or more specifically, not doing all of it. Now, if you're purchasing a newer home, you're probably going to have a home inspection done, which is going to make you aware of any areas of concern. This is often more difficult if you're purchasing an off-market property though. And remember, regardless of the specifics of the property you might be interested in, there is always going to be a risk associated with buying real estate. Due diligence is about mitigating that risk. If you're planning on doing some remodeling, particularly things like additions or even a tear-down rebuild, you're probably going to want to know what types of restrictions the HOA has and what the permit process looks like in that jurisdiction. Due diligence should also include not only what the current rental market looks like, but what the forecasts say it might look like in the future. If you're surprised after you've purchased a house, that usually means it's going to cost you more money. If you know the house you're interested in is going to need foundation work, you can include that in your budget before you make the offer. But if you don't find out about it until after you bought the house, that will seriously impact your profitability. Now, this leads to the fifth deadly sin of real estate investing, which is not having a clear investment strategy. Now, there are two sides to this. On the one hand, you want to make sure that you have some options. Let's say you're flipping a property And after all the remodeling is done, you're not able to get the kind of money that you need to get if you were to sell it. What would be your contingency plan in a situation like this? Would you be able to rent it, at least get enough money to pay the taxes, the insurance, and any kind of outstanding mortgage? If not, do you have enough reserves to cover those expenses until you're able to sell the house and get the kind of money that you want to get for it? Now, where this could become a very big problem is when your plan is not as clear and well-defined as it should be. And unfortunately, you're not going to know how solid your plan is until after you've bought the house. Before you bought the house, you might have wrote on that spreadsheet that you're going to get all the remodeling done in 6 months. But after you're 4 months into the remodel, you figure out that you're going to need at least 3 to 4 more months before you can finish it. When you're in the middle of a remodel like that, any additional time is going to cost you money. And hopefully you'll be able to figure something out. Have you ever seen those listings on the MLS when a house is up for sale and it looks like half the remodel is done? That's an example of an investor who ran out of money in the middle of a remodel and is trying to sell that house to recoup their costs. Most times they're going to be very lucky if they're able to even break even. So please, don't let that be you. Now, kind of related to what we just talked about, the sixth deadly sin of real estate investing is underestimating your expenses. Now, this could be the result of inexperience, underestimating the scope of work that needs to be done in order to complete the remodel, or not anticipating price increases in either material or labor. Bottom line, if you budget $5,000, it costs you $10,000, that extra money is going to need to come from somewhere, if you even have it. There are some investors who are do-it-yourselfers. There's nothing wrong with that. If you have the skills and the time to do the work, and you're willing to accept the liability for any issues with that remodel at any point in the future. Now, the reason I bring this up is that underestimating the length of time it takes to complete a remodel for a do-it-yourself flipper may not only impact and increase the amount of money that's needed. If you forecast you can complete a job in a week, but it winds up taking you a month, you've not only increased your cost of holding that house for that additional time, but whatever additional time you're going to need to complete that remodel means that something else is either going to be ignored or not going to get done. Now, the seventh and final deadly sin of real estate investing is ignoring market trends. Anybody involved in real estate investing has a certain amount of confidence in their ability to analyze the real estate market and forecast trends. This is a strength, but it can also be a liability if that person is not willing or able to listen to other points of view. We all have sources of information that enable us to make decisions regarding real estate investing. This can be that celebrity real estate guru or that small group of advisors that you might have, your accountant, your lawyer, or your real estate agent. It is vital that you have a group of subject matter experts that you trust and who give you good advice. The problem with having a small group of advisors like that is that we tend to be the most comfortable around people who think the way that we do. For example, if every one of your advisors is anticipating a recession coming later this year, they're probably going to be very cautious about making any purchases right now. But what if someone from outside your circle presented you with data that indicated that we've already hit the bottom and we've already begun the recovery? You don't necessarily have to accept their point of view, but honestly, would you be willing to at least listen to what they have to say? For the most part, investors should do the complete opposite of what everyone else is doing. A year ago, when everybody was going crazy buying a house, do you think that was the ideal time to buy? Of course not. That was the perfect time to sell. Now, the opposite argument could be made for today. Everyone is cautious and not sure what to do, so they're pulling back and avoid making a decision. Do you think that's the ideal time to sell? Of course not. Sellers are offering concessions and offering price reductions. A speculator is concerned about what's going to happen in the next 6 to 12 months. But a real estate investor should be concerned about what's going to happen in the next decade or more. Speaking of which, this video has some very useful data about trends in the median prices. Check it out and you might get a different perspective of what's really going on out there. And don't forget to subscribe to my channel and ring the bell. That way you'll get a notification every time I post a new video.